Terrific. So let's start perhaps with you, if you don't mind, Evelina. We were chatting just a little bit before we came on about how we should think maybe a little bit differently. In particular, the topic that Lord Turner was waxing eloquent and offering professorial lessons in chemistry about, that is the hard-to-abate sectors or industry. You specialize in this area, among others, but you have some thoughts on maybe how we should think about the right tools for the job, how maybe we have some outdated forms or ways of thinking about financing the transition when it comes to the hard-to-abate sectors. Will you tell us, kick us off with your thoughts on that area?
Yeah, absolutely. And maybe I'll start off with sort of questioning the idea of the hard-to-abate sector. It's interesting because for a long time, these sectors were called that because it was incredibly difficult to even begin thinking about how we decarbonize them. What's changed is that there are increasingly solutions to help us decarbonize the former hard-to-abate sectors. And we're talking about things like cement, steel, HGV trucking, aviation, and the like. So the solutions exist, but the challenge now is actually scaling the solutions to help decarbonize them. And that in part is why my organization exists, is to help move capital. And I would say that the challenge has shifted from how do we conceptually understand how to decarbonize them to how, in practical terms, do we move the institutional amounts of capital we need. And it's eye-watering amounts of capital because we're talking about, our tangible real economy to actually scale up those solutions in a timely enough manner to bend the curve to net zero to help us.
We're talking trillions of dollars over the course of the next couple of decades, right? And just so people know, they might not be familiar with your organization. Where do you fit in the capital stack or in the in the financing world? What does your group particularly do?
I'm with Just Climate, and we are an asset manager, and we're what we call a climate-led asset manager. What that means, quite simply, is we focus on scaling institutional capital towards solutions that can generate outsized abatement while also generating attractive returns. Attractive returns because without those, we are not going to get institutional capital from your sovereign wealth funds, pension funds, the world's biggest asset owners. And coming back to your point around trillions and trillions, that's what we need.
So I like this idea, climate-led. What does it mean in terms of financial returns? Because some of the very greedy types back in Wall Street, I'm from New York, they're not bought into this. They thought ESG was BS. And, so they tend to scoff when someone says, I can do good and also make a lot of profit. Or they would say there must be some kind of trade-off between financial returns and these other returns for climate. Or maybe you're a philanthro-capitalist outfit, kind of a do-gooder. What do you say to people like that?
I would say it's all of the above. There's a full spectrum of capital, from the philanthropic to what you call commercial returns. But also commercial returns depend on what you're benchmarking them against, right? Commercial for infrastructure, which is low risk, low return, is not the same as commercial for growth equity investment, which is higher risk and therefore higher return. What we would say is there are really important solutions for decarbonization across that capital stack. There are things today which we don't know how to decarbonize or find commercial business models for. But there are plenty of things where there's a commercial business model that we can back and deploy capital towards that will help us decarbonize these highest emitting sectors that are the most off track. And those are the specific types of opportunities we back, coming back given our mission and given the type of capital we're trying to move towards these solutions at scale to get them to ramp up. So
just to stick with the theme for a moment, and I'm mindful we have two other excellent speakers we're going to come to in a moment, give us an example of an area that you think meets the test of being climate-led, but also providing good returns and might have been overlooked by others that you're directing capital to. But I'll also ask you the opposite. What's an area that you think doesn't meet that test? It might be climate-friendly, but a money loser, or just financial returns, climate doesn't meet your test within the broad area of industry. Just so we know, we can be specific here. We want to get crunchy with our audience here. It's a very sophisticated audience, so they want to hear some tough answers from you.
Okay, I'll give an example from kind of the industrial opportunity set, which is one bit of the formerly hard-to-abate space, the space formerly known as hard-to-abate, and also the natural climate solution space. So on the commercial side, so we actually have backed a few companies in this space. We've backed a player that's looking to decarbonize steel production by 95%. And again, that's a commercial entity. We have backed a player that decarbonizes paper and wood-based industries. One of their clients include our favorite blue and yellow store, basically, that are trying to decarbonize their operations. And what they do is they take waste, wood and paper waste, and use it to produce a synthetic natural gas, which produces biochar at the end, which is a permanent store of carbon, replacing fossil fuel natural gas. Now, all of these are really attractive investments from an IRR perspective for your standard. It's interesting if you're underwriting it purely for commercial terms. But on the other side of things that are a bit more difficult to back commercially, a really obvious thing that we need is conservation, right? One of the first laws of holes is stop digging the hole. And unless we conserve a lot of the forest cover that we still have, we will continue to compound our problem. However, at the moment, there aren't really commercial business models that will justify leaving things as they are, if you will. There's excellent philanthropic ideas. There's lots of financial market innovation, rhino bonds, things like that.
Right.
But we haven't found commercial opportunity that fits within the expectations of our investors.
Okay, so those are two good examples. I'm glad you had good answers at the ready. Let me roll it back a little bit, maybe to get an overview of this area. Nicki, I'll come to you. You look after sustainable finance for environmental defense. I suppose I should start by saying congratulations. She's managed to put up her own satellite into space a couple of days ago. Elon Musk sent it up there. So congratulations on Methane Set. I know you did it all by yourself.
Yeah.
No help from anyone. And so if any of you are emitting methane, be careful. She's watching. She's got her eyes on you. But more seriously, talking about sustainable finance, can you sketch out how EDF looks at where we need to go in sustainable finance?
Sure. Well, perhaps if I start with what EDF are, and then I'll come on to that. So
I thought everybody would know, especially with the eye in the sky, but please.
We're an environmental NGO. We operate globally. We've got anchor regions in Europe, the US, India, and China. And we are really about bringing a pragmatic and science-driven approach to solving difficult environmental challenges. And Methane Sat is a sort of great case in point there. And we work with companies, with policymakers, and with financial institutions on coming up with solutions to these problems. And so in terms of the financial sector specifically, we think about what are some of the different actions that the financial sector can take. So one of the first things is obviously setting goals and targets and strategies. And this is a key kind of thing. There's been this whole wave of target setting with GFANS in recent years, and we think that that's got a real kind of role to play in decarbonising. We've got the 2030 targets that a lot of banks have set that are sort of coming up. And then, the financial sector clearly has got the role then in pushing the companies that they invest in to decarbonise and to accelerate their decarbonisation plans. And to do that, they can create products and services for the decarbonisation, and they can provide resources and advice. And depending on the sort of company that you're talking about, we work, for example, in the agriculture sector. That resources and advice piece, is particularly important in a sector like that. And then finally, they can advocate for public policy changes. And I think this is one of the key sort of things is the amount that the private financing gap is huge, and it's only going to be able to be filled if we've got the right public policy frameworks in place that then can catalyse the green transition. And that really does need the financial services companies working with governments to create that policy, the right public policy environment, and to advocate for that.
Now, of course, the financial sector often works closely with government. There's no shortage of advice coming from the financial sector. We'll hear from Heather in a moment about that. However, it's not always in line, let's say, with climate goals. I think that was one of the important and very sharp outcomes of high-level working groups' report to the Secretary General last year at last year's COP in Egypt, which pointed out very clearly to avoid greenwashing that companies that make public postures or take a stand must not lobby quietly against those exact same positions, which has been demonstrated time and again does happen. Not just financial sector, oil companies, others as well. They'll say they sign up for something, but that in fact they go and lobby for something else, that this needs to be called out. That's a form of greenwashing that is not acceptable. And so it's not just taking a position, but
Absolutely.
Consistent with certainly what you say publicly and maybe more broadly with that the goals of dealing with climate change and sustainability issues. Do you find when you deal with institutions, we're here to talk about financial sector particularly, that there is a tension between, for example, we've seen it between American financial institutions and those in Europe on what is their fiduciary responsibility, right? We've seen this tension explored in terms of shareholder returns or legal obligations to produce highest financial returns versus those that might be involved with a collective action working towards dealing with GFANs or other climate-oriented organization. What do you advise or what do you advocate when you have potential partners in the corporate world and you do work with companies to help them when they say, look, we want to do the right thing, but we're not sure, or they don't even pretend to do the right thing, they just do the wrong thing. What do you advise them, or what sort of position do you take?
Yeah, look, and it's a very tricky issue, and I think one of the interesting things working in a global organisation like EDF is you actually see how it plays out quite differently, this side of the pond relative to the other side of the pond. And I think, unfortunately, we have seen that the anti-ESG movement in the US has had quite a chilling effect on the ambitions of the US financial sector players, and they're quite often behind the scenes trying to do some of the right things still, but they can't broadcast, what they're doing. Indeed, actually, maybe some of the public policies, they look like they're rowing back on it. And are they in practice? Are they not? I mean, I think that's the jury is out on that. But I think, and then this side of the pond actually. There has been more ambition, I would say, and I think that's sort of to be welcomed. But it's about really keeping the pressure up on that ambition and really like calling, the financial sector to account to make sure that they do meet those, targets and those ambitious strategies that they've set, and that they don't try and use the kind of excuse of the political environment to row back on those pledges.
That's a good point, or a moment to turn to you, Heather. You talked about how the environment is different here than it is on the other side of the pond. Can you talk a little bit about that? And maybe give us an idea. What does Bankers for Net Zero do? And what's its relationship with GFANGs? And how you see this question about maybe some of the transatlantic difference of opinion?
Yeah, certainly. So Bankers for Net Zero, we're a small not-for-profit membership body. Despite the fact that we're called Bankers for Net Zero, we're more than just bankers. And so our members include NGOs, academics, small, from the big banks down to kind of small building societies and stuff like that. So
and you're UK focused, am I right?
So we're UK focused. So we convene the UK country chapter of the Net Zero Banking Alliance. So we sit within that GFAN structure. And we're also Race to Zero accelerators. So we look very, very specifically at that little line that in the Net Zero Banking Alliance commitments that says that banks have committed to decarbonising their finance emissions by 2050. And I always kind of joke that banks could be net zero by tomorrow if they wanted to, but they just have to get rid of all their customers, which might have some adverse effects in other places. So,
right.
Because people don't really realise that means that they're now on the hook for every single mortgage, every overdraft if it's secured, every business loan, every corporate loan, and the corporate's entire supply chain.
Now, the members, you count some of the leading banks in the UK as your members.
Yep.
How do they grapple with the issue that has tripped up some of the American banks that, even aside the politics of it, let's say, they have even big sustainability or green bonds divisions. They have previously ESG, now maybe they're called something else now, investments that they like to tout. But at the same time, they're also continuing to be big financiers of, let's say, coal projects or at least natural gas and LNG projects as part of the transition, and arguing that, in fact, this is consistent with the energy transition. Where do your banks fall out on this? Because politically, that may not be so palatable on this side of the Atlantic.
Well, I think there's increasingly a move towards, and I think in COP this last COP, that there's that clear kind of direction of travel away from. I think one of the interesting things that we've done, kind of leading on in the UK here, and everybody's following, is around transition planning and actually having that clarity. I mean, I think we're getting to an inevitability, but not everybody has done there yet about no new drilling going forward. But it's particularly those that work on a global scale. It becomes quite tricky. I do think, though, in the UK, we're fortunate in that the political environment, even in its most extreme, just doesn't go where.
This ain't Texas.
Yeah, exactly. Not Texas. And interestingly, I mean, I've had the numerous conversations with regulators, and our Competitions and Markets Authority came to us once and said that if anybody tries to say that they can't play with each other because of antitrust issues, send them to us. We've created a space for that. So I think we've got a much more kind of progressive environment to test those things. But at the end of the day, a lot of stuff is still getting led on voluntary commitments, and if we really want it to change, then regulators and governments have to step in. And what's been really interesting over the last couple of years, seeing where we started at COP26 with making commitments, and probably a bit of blind panic when people realized what had actually been signed up to and the depth of it. Fast forward 2 years, and I see a lot more frustration from the private sector that government isn't acting fast enough and isn't raising the bar. So those that are kind of going ahead are saying, well, actually, no, bring everybody. The lowest common denominator here is too low still. And so that's been a really interesting thing just over the last couple of years. And you're getting really large corporations calling for more consistency in regulation and then levels the playing field.
Well, they are, but at the same time, sometimes they don't like the outcome of this, right? I'm thinking about the current row over the Basel III requirements that are soon to be implemented, as you will know, and I welcome views from any of you that want to jump in on this. For those of you that don't follow the technicalities of it, we're anticipating new guidelines that should apply across the central banks and into the banking sectors that would affect how climate risk is accounted for. And there's a pushback from the renewables industry suggesting that, in fact, this would disadvantage lending. The way that risk is apportioned to clean energy is unfair in their view. Now, that's one point of view, but nevertheless, not all standardization is welcomed by those who want climate investments. You want to jump in?
I'll come in on that.
Yeah, good. I thought you
Prior to my time at EDF, I spent 15 years at the Bank of England.
Oh, there you go. So you're to blame. Why did you come up with these regulations?
I used to live and breathe it. No, so, I mean, look, what I would say is that bankers have been complaining to regulators about capital requirements since they were first invented. So I see the sort of complaints around what they will do to the climate, to the renewable industry, as just an extension of what we used to see with the lobbying around small businesses. So small businesses used to be the thing that would be horribly impacted if us terrible regulators, introduced capital rules. And so for me, that's just an extension of the lobbying piece.
Really? Oh, that's very interesting. Is an environmentalist saying, don't worry about it. Central banks are right on this one. I didn't expect that. Anyone have a different point of view that follows this issue? Does it affect your business at all? Or is it a bit removed from what you do?
It is a little bit more removed.
Yeah.
Given that we focus on the equity side of the capital deployment.
You don't do any kind of debt?
We don't do any debt financing, but a lot of the businesses that we look at do require a lot of scale up, and so debt comes into the capital stack.
Right.
But I think probably not at the scale that would trigger any kind of anxiety around this kind of new regulation.
Yeah. Okay, fair enough. Well, we'll have to see what happens. And if there are any Basel III experts in the audience, we certainly look forward to being educated over the next coffee break. Since you talk about equity, can you talk a little bit about the environment in which you see right now? And some people suggest that this might be something of a winter for I was just speaking with some private equity and venture capitalist associations. They're seeing a downturn. The interest rate environment hasn't helped. We've had supply chain challenges, obviously, affecting wind, solar, various other capex-heavy industries, I should say, that there's a debate on whether climate tech is an exception to this rule, AI and climate tech being small hotspots, or whether this is going to be a broader downturn in this area in terms of capital coming to this. I'd be curious, from your vantage point, how you see your area of investments being affected by the global trends.
So it's interesting. There's probably a couple of levers. Overall, given that we are quite specialist in our investment lens and we focus on kind of quite narrowly on the industrial side, specifically sort of the vertical solutions to the sectors that I mentioned, and similarly quite narrowly focused on the natural solution side to be climate-led, it means that we do benefit a lot from the massive sectoral tail, and arguably the biggest one in recent decades that drive that, primarily because we urgently need to decarbonize these spaces. And the pressure is coming it's not a nice to have, but regulation is shifting primarily more so in Europe than sort of in the US, for example. There's regulatory pressure, there's demand pressure, and you're seeing that not just to decarbonize the industrial economy, which we've been aware of around how do you decarbonize steel, HGV trucking, all of those things, but even on the food and ag side, there's increasing pressure for getting our food produced in ways that are deforestation free, that come with a lower carbon footprint. And so there's a lot of demand for these things which don't yet exist, and they need to exist at scale for corporates to meet their net zero commitments, for countries to meet their net zero commitments. So that creates a natural demand for the goods and services of the kind of businesses that we invest in. Obviously, they don't operate in a vacuum. And so if there are issues around access to debt as you're trying to scale an industrial company, that has an impact. If there are problems around the corporate balance sheets of some of the bigger customers that you're looking at, that's highly problematic. So I'm not trying to sort of paint an entirely rosy picture, but I would say arguably because, as you say, there are more specialist niches that are relatively sheltered from some of the bigger trends than others.
One topic I wanted to discuss, and I wanted to get the audience's input on this, is ESG, which, as we know, has had a rocky ride, but a massive and European or originated trend. Let me get a show of hands. How many people in this room of self-selected finance-oriented people have either worked in ESG or have had some association with ESG funds or related areas at corporations in the last few years? Okay, overwhelmingly, I would say easily 80%, just on a rough count. Is ESG dead? What did my panel of experts say? When I looked at the latest count of ESG funds created year by year, we saw a massive uptick. But last year, the latest year for which we have data, 99% decline in new ESG funds from the year before. What's happened? What can we learn from the experience of ESG, if one of you wants to jump in?
Well, maybe we could start off with the term ESG itself, because it's used to capture so many different things. And initially, it used to be focused on public markets funds, right? So it was a lens that was applied to screen investments into public markets funds. And in the US, that's a lot of where the terminology remains. On the private side, and arguably it should be around all asset management, we would, for example, at Just Climate, we think of ESG, which is environmental, social, and governance factors, as just a part of standard integrated investment management. You need to consider these things when you're deploying capital, making investment, because those things will affect your company's prospects, which ultimately drive value. So it's not even like it's the right thing to do. It is inextricably linked to the value of your long-term value of your business.
Right.
And that's the lens that we would apply. So it's become less fashionable, but arguably in many ways, it was never decoupled from capital deployment, but it's been weaponized in really interesting ways that create the illusion that it's something other and additional to. You can optimize for certain things in the same way you can optimize for certain environmental outcomes, so focusing on sort of starting with a climate lens or a social justice lens, but it is not in any way different to capital allocation decisions and just those things being part of your capital allocation framework.
If that's true, that is now it's in a sense a minimum price of doing business, of doing good business. What were all those funds investing in?
So
you can see why people get a little bit upset about this particular outcome, right? If it was always a good thing to do, why set it aside and spend trillions on it?
So arguably, this is where it comes down to things being weaponized. There is what it is intended to be and what a lot of fund managers, I would suspect, treat it as, which is just a part of sound investing.
Right.
And there are ways that you can be a little bit disingenuous, intentionally or not intentionally, or folks who actually realize there is a trend and they put a sticker on it. It's like in the supermarket, depending on whatever is hot, suddenly everything is gluten-free. Like, an apple, which never had gluten to begin with.
Right.
So there's a little bit of that in the market. And so there was this proliferation of ESG type things. And a lot of those funds, some of those funds that are no longer ESG, probably invest in the same things that they did for different reasons. Because now they're talking about, actually, it's not about ESG, we're a healthcare fund.
Right.
Whereas before there were ESG because we're focused on sort of certain social outcomes, health, sort of etc. So, and I'd welcome sort of my panelists.
Yeah,
opinions of
Heather,
this
I saw you chuckling over there. Well, what do you think about her gluten-free apples? How about them apples?
But I think, I mean, ultimately, right, I mean, ESG is just a framework of kind of identifying your risk elements in a business, potential risks. And I don't think anybody would object to that kind of analysis or to an analysis of risk for any investment decisions. But I think particularly in the S area, which is less well defined, and I mean there's enough difficulty even measuring the E, and that's miles ahead. It becomes an easy plaything of kind of different kind of political interests all of a sudden, making this something about the kind of fall of civilization rather than an investment framework, which we've seen it turn into. So, to a certain extent, I think a lot of the chat now is a lot of the framework's still probably going to be there, but we might just need to call it something different. It's as simple as that, because it has become so loaded.
How about you, Nicki? What do you think about this?
Yeah, look, I mean, I think my fellow panelists have made a lot of the points I would agree with. And I think the risk, if you start with the risk management side, ESG, for whatever you want to call it, it should be part of good fundamentals of risk management. I think the question is then, are you doing something that is above and beyond integrating those ESG considerations into your portfolio? And I think, obviously, as an environmental organisation, what we would argue is that, firms should also then start to think about beyond that. What are the impact objectives that they would like to achieve? How will they be considering those?
Are we now, instead of seeing those funds that are interested, legitimately and genuinely interested in working on climate or decarbonization issues, maybe being rebranded to go into energy transition investing, or what Larry Fink at BlackRock calls brown to green investing? Is that the new flavor of the month, or is that something different? I wonder how you see, because it is something I've detected a lot more market interest in. Is it legitimate, or is it a form of greenwashing? I'm curious to know what you all think about this new trend.
Well, so first and foremost, I don't think they can. The two things are mutually exclusive. In the first instance, with ESG, let's name it something different. But here we've got a risk framework, and then I mean the brown to green. I think we need to. It's critical. I mean, this is transition planning, isn't it? And embedding transition planning and. If you're in a room full of geeks, which we usually are, then everybody can talk about transition planning kind of happily. But we need to get to the point where even your small businesses kind of going in and talking about their transition loans with what are the frameworks that are available for them to help get from A to B. And so it needs to become very kind of a bit more kind of IKEA in its thing. So I think it absolutely has to be part of it. I think the interesting thing around a lot of this, particularly in the reporting side, when we talk about greenwashing and green hushing and everything else under the sun, is that we need to get better with the data. So a lot of the data just isn't there, or it's there but it's not being used, or it's not assurable in a way. So there's a lot of opaqueness through that. But also in terms of how things are reported, companies can still look better. Like companies that aren't looking and aren't kind of really assuring their, verifying their data and all the rest of it, can make themselves look better than those that are. So the ones that are being the most kind of honest and diligent often look the worst because they're being kind of transparent about it. And so I think there's probably a shift that we need to do in that as well, and saying if you're not looking, you're red. You know what I mean? And once you start looking, you may still be red, but then at least we can start tracking where you're going.
That does touch on one of the other trends that's going on, of course, and that is rather than greenwashing, we're seeing green hushing, right? Lots of companies, even if they're doing good things, they don't want to get caught out or be unfairly targeted, so they're keeping quiet about the good things and not making a big noise. I wonder, is that something that you see in your work? Are you seeing companies being a little more quiet about what they're doing in this green hushing?
I mean, yes, I think particularly the US-based firms, all those that have got a presence in the US. But just to go back to the transition finance question, I mean, I think there is a real risk here of greenwashing, and I think, but then at the same time, there is also real potential in this, in using transition finance to unlock, further decarbonisation. And I think for us, one of the things that we think about is A, the transition plans bit, but then B, how do you link transition finance to clear and achievable KPIs and metrics and targets, and also to sectoral pathways? And I think that's a really sort of important part in making sure that transition finance is genuinely going to decarbonisation rather than to that kind of...
Can you say a little bit more about this? Because it's massive amounts of money that are coming into this. And when we think about the transformation of the capital stock that has to happen in the next 30 years, it's not just building the innovations, of course. We need to transform the existing capital stock, and that's the theoretical underpinning for the brown to green thesis. When I was reading the detailed prospectus for BlackRock's materials fund, it's a brown to green materials fund. Sounds great. We should have cleaner materials. And the letter from Larry Fink related to it, he talked about, this is going to take a long time. It takes a while. We can't just have only the ESG or green investing. We have to start with brown to green, and maybe even start with brown to khaki. And I thought, cute turn of phrase, but what does that mean exactly? How do I measure khaki versus any other shade of brown? And is it really much greener than it would have been otherwise? Because we know the natural progression of how capital stock turnover happens. When you replace a 30-year-old or 40-year-old piece of kit, you generally buy the latest equipment, which tends to be cleaner and more efficient anyway because of technological progress, digitalization, Internet of Things, predictive maintenance. We can go through a lot of the reasons why, for nothing to do with the environment, it would be more efficient and cleaner anyway. And so are we just directing so-called green money to go to something that would have happened anyway? Where's the additionality? And so I'm curious to know, as we think about this, how will we get some rigor so we don't end up having a new bubble that has a backlash as the ESG bubble clearly had a backlash, particularly in the US, and not set ourselves up for more allegations of greenwashing when people might be quite sincere in trying to pursue this? Any analytical work you think your shop might do, or others?
Yeah, I mean, look, I think it's a really important question. There's no sort of single answer to that. I mean, clearly taxonomies could be a part of it. At the moment, you've got the green taxonomy as a question of should you be having a transition taxonomy, or indeed, I mean, I think the way that the EU see it is you would put transition within the green taxonomy and then slowly change the taxonomy, the green taxonomy criteria over time to tighten those up. So I think taxonomies is probably one part of it.
Heather, sorry, go ahead. Yeah.
Well, I just think one thing that we haven't really kind of mentioned in this, and absolutely taxonomy, and we're building the plane as we fly it here. I mean, fundamentally, we're risk and value are getting redefined at an extraordinary rate, and so I think we have to accept that level of kind of insecurity that sits within that, and that things aren't going to be perfect, and it often means people, more risks getting taken. So I think this is what we haven't really talked about, the kind of the role of blended finance, or the fact that to really kind of get the ambitious projects going, it's not going to be funded by a bank. It's not, it's going to be probably funded by a consortium and bring in risk, insurance, potentially some government guarantees to kind of take a slice of risk, private equity and finance to actually kind of get things moving. And I think we have to think a bit more ambitiously and at a larger scale, and there will be, it's to say it will get better as the data gets better and all the rest of it. But the other point is then we just don't do it because we're all afraid to get a slap on the hand.
Evelina, you had something to say on this.
Yeah, absolutely. And I wanted to build on what you said before, because I think the answer to this is very boring and very simple, which is data and comparability. When it comes to when you're picking between BlackRock's latest fund, sort of the materials fund versus another one, the average investor will look at returns, right? And there aren't different ways of measuring returns. There are industry understood ways. When it comes to delivery of any other goals, impact goals, and many of these funds that deliver commercial returns have stated impact goals, we don't have the same comparability. Everyone's talking about their innovative, revolutionary way of measuring impact. That's the last thing we want. We want everyone to be bog standard, so we're competing on performance. And then asset owners can make informed decisions around, for my transition planning, what kind of things do I need to invest in to get my portfolio to be decarbonized and to help transformation in the real economy, right? And then you have a theory of change, because they would have to report same as we would, and we take the data piece very seriously, zero surprises, same as any other fund. And then the biggest asset owners can make very informed decisions aligned with their theory of change around how much GHG abatement is this going to drive, what is it not going to do, and what are we leaving? And then you can, again, coming back to informed asset allocation, but we need the data, and regulation, I think in this context is incredibly powerful, and Europe has made huge strides with that, right? Sort of in terms of regulation coming into place next year in the UK, I think across the EU even sooner. So,
well, I think you've made a very important point, and I owe the audience an apology because when you came here today after lunch, I said we're going to have an exciting, dynamic set of sessions on the future of finance, and we just found out that the future of green finance needs to be bog standard and boring.
Yeah.
And frankly, I think you're right. So with that, let's give our panel a nice round of applause. Thank you very much.
Thank you.